The silver market just experienced one of its most devastating collapses in recent memory. And if you were caught on the wrong side of this trade, you know exactly how brutal it was. Before we dive into what just happened and what comes next, make sure you hit that like button, share this video with anyone trading precious metals, and drop a comment below telling me if you saw this crash coming. Your engagement helps us bring you the critical market updates you need. And stick around until the end where I'll reveal what's coming in our next video that could help you navigate the aftermath of this chaos. Silver has just plunged from $83 per ounce down to $75, and this wasn't a gradual decline. This was a full-blown crash that wiped out positions, triggered stop losses across the board, and left traders questioning everything they thought they knew about this bull market. The resistance level that everyone was watching didn't just hold, it absolutely crushed anyone who tried to push through it. This is the kind of price action that separates seasoned traders from amateurs. And right now, the market is telling us something very important about where we're headed next. Let's break down exactly what happened here. Silver had been on an absolute tear, climbing from the low 70s and building momentum as it approached that critical $83 level. The bulls were in control, sentiment was incredibly optimistic, and it seemed like breaking through to $85 or even $90 was just a matter of time. Traders were piling in, leveraged positions were mounting, and the fear of missing out was driving buying pressure to extreme levels. But the market had other plans, and those plans involved teaching a very expensive lesson about resistance levels and risk management. When silver hit $83, it ran straight into a wall of selling pressure that had been building for weeks. This wasn't just retail traders taking profits. This was institutional money, large commercial traders, and smart money that had been waiting patiently for this exact moment to unload massive positions. The rejection at $83 was swift and merciless. Within hours, silver was trading at $80. Within a day, it had crashed through $78. And before most traders could even adjust their positions, we were staring at $75 per ounce. This $8 collapse represents roughly a 10% decline in a matter of days, and in the leveraged world of futures and options trading, that kind of move can completely destroy accounts. If you were trading on margin, if you had call options positioned for a breakout, or if you were simply holding physical silver expecting higher prices, this crash likely hit your portfolio hard. The speed and magnitude of this decline is what makes it so dangerous. There was no time to react, no opportunity to exit gracefully, and no mercy for those who ignored the warning signs. But here's what many traders missed in the lead up to this crash. The warning signs were actually there if you knew where to look. Volume patterns were showing divergence as silver approached $83. While price was making higher highs, volume was actually declining, which is a classic bearish divergence signal. The commitment of traders' reports had been showing commercial traders building massive short positions in anticipation of a reversal. And technical indicators across multiple time frames were flashing overbought conditions that screamed caution. Yet the euphoria in the market drowned out these warnings, and now we're dealing with the consequences. The current price of $75 puts silver at a critical juncture. This level represents a significant support zone that held earlier in the year, and whether it holds now will determine if we've just seen a healthy correction or the beginning of a much deeper decline. If $75 fails to hold, the next major support doesn't come until around $70, which would represent nearly a 16% decline from the recent highs. That's the kind of move that can trigger capitulation selling and shift the entire market narrative from bullish to bearish. What's driving this collapse beyond just technical resistance? The fundamentals have shifted in ways that many silver bulls refuse to acknowledge. The dollar has been strengthening against major currencies, which puts downward pressure on all commodities, including precious metals. Real interest rates have been climbing as inflation expectations moderate, making non-yielding assets like silver less attractive compared to bonds and other fixed income investments. Industrial demand, which accounts for more than half of silver consumption, has shown signs of weakening as global manufacturing activity slows down in response to tightening financial conditions. The relationship between gold and silver has also been telling us something important. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, had compressed significantly as silver outperformed gold on the way up. But that ratio has now started expanding again, indicating that silver is underperforming relative to gold, which is often a warning sign that precious metals as a whole may be entering a correction phase. When silver starts lagging gold, it's usually because the speculative enthusiasm that drives silver's more volatile price action is fading. Looking at the broader market context, we're seeing the silver crash happen against a backdrop of significant uncertainty in financial markets. Equity markets have been volatile, credit spreads have been widening, and there are growing concerns about economic growth prospects for the remainder of the year. In this environment, silver often gets caught in the crossfire. It's considered both a precious metal and an industrial commodity, which means it faces selling pressure from two directions. Investors seeking safety might rotate out of silver into gold or cash, while industrial buyers might scale back purchases in anticipation of lower demand. The options market is also telling a bearish story right now. Put option volume has surged as traders rush to buy downside protection, and implied volatility has spiked to levels we haven't seen in months. This suggests that professional traders are positioning for further downside and are willing to pay up for insurance against additional losses. The open interest in silver futures has also declined significantly, indicating that leveraged long positions have been forced to liquidate, which can create a cascading effect of selling pressure. What about the mining stocks? Silver mining companies have been absolutely hammered by this price decline. Many of these stocks trade with leverage to the underlying metal price, meaning they tend to fall faster than silver itself during corrections. We've seen some mining stocks decline 15 to 20% as silver dropped from 83 to 75, and if silver continues lower, these stocks could face even more severe declines. For anyone holding mining stocks, this is a painful reminder of the risks that come with leveraged exposure to commodity prices. So where do we go from here? The honest answer is that the next few days are absolutely critical for determining whether this is a buying opportunity or the start of something worse. If $75 holds and we start seeing stabilization with increasing volume on any bounces, then bulls might have a case that this was simply an overextended market correcting back to more sustainable levels. A successful defense of 75 could set up a consolidation phase that builds a base for another attempt at higher prices down the road. However, if $75 breaks decisively, particularly on high volume, then we need to seriously consider that the entire rally from earlier this year may be at risk. A break below 75 would likely trigger another wave of stop-loss selling and could quickly take us down to test the $70 level. At that point, the psychology of the market would shift dramatically. Traders who were buying every dip would become much more cautious, and fear would start replacing greed as the dominant emotion. For those wondering whether to buy this dip, the answer depends entirely on your risk tolerance and time horizon. If you're a long-term physical silver investor who believes in the fundamental case for higher prices over the next several years, then these pullbacks might represent opportunities to accumulate at better prices. But you need to be prepared for the possibility that prices could go lower before they go higher. And you need to size your positions accordingly without using leverage that could force you out at the worst possible time. For traders, this environment requires extreme caution and discipline. The volatility we're seeing can create opportunities for skilled traders who can read the price action and manage risk effectively, but it can also destroy accounts very quickly. If you're going to trade in this environment, you need to use tight stops, proper position sizing, and you need to be willing to sit on your hands when the setup isn't there. Forcing trades in a market like this is a recipe for disaster. The technical picture suggests we're likely to see continued volatility in the near term. Silver could bounce from current levels as bargain hunters step in and short sellers take profits, but any rally will likely face resistance around $78 to $80, which was previous support that has now become resistance. Until we see a clear break back above $80 with confirming volume, the trend remains bearish, and the bias should be to sell rallies rather than buy dips. One thing that's important to understand is that crashes like this are actually a normal and healthy part of bull markets in commodities. Metals don't go straight up forever, and these violent corrections serve to shake out weak hands, reset sentiment, and create the conditions for the next leg higher. The question is always whether this particular correction is the normal kind that presents buying opportunities, or whether it's the kind that marks the end of the entire bull cycle. Right now, it's too early to tell, which is why patience and capital preservation should be your top priorities. The coming days and weeks will provide more clarity. Watch for how silver behaves at this $75 level. If we see multiple attempts to break lower that fail, if we see buying volume increase on bounces, and if we see positive divergences start forming on indicators, then we might be seeing a bottom form. But if selling continues relentlessly with each rally getting sold immediately, then the path of least resistance remains to the downside. Remember that in times like these, Capital preservation is more important than trying to catch the exact bottom. It's better to miss the first 10% of a new uptrend than to lose another 20% trying to be a hero. The market will always give you another opportunity, but only if you still have capital left to deploy when that opportunity arrives. Don't let ego or stubbornness cause you to hold losing positions hoping for a miracle recovery. Accept the loss, preserve your capital, and wait for a better setup. This is exactly the kind of market action that separates those who will survive and thrive in trading from those who will blow up their accounts and give up. The lessons you learn from experiencing a crash like this, if you survive it, are worth far more than any profit you might make on a winning trade. These are the moments that teach you about risk management, position sizing, the importance of stops, and the danger of letting emotions drive your decisions. Now before you go, make sure you're subscribed to this channel, because in our next video, we're going to dive deep into the historical patterns that follow crashes like this one in silver. We'll look at every major silver correction over the past 20 years, analyze what happened next, identify the signals that mark the bottoms, and give you a roadmap for how to position yourself for the recovery when it comes. You don't want to miss that video because it could be the difference between catching the next major move or sitting on the sidelines in fear. Hit that subscribe button right now, turn on notifications, and I'll see you in the next one, where we decode the recovery playbook for silver.